Hello and welcome to the video on the journal entries for bad debts or irrecoverable debts. A bad debt or an irrecoverable debt means that no payment will be received and therefore the value of the debt will be written off. In other words, the business accepts that the debt will not be recovered. Consequently, the debt is deducted from the trade receivables value as revenue is lost. The following entries will happen to record the bad debt or irrecoverable debt. Number 1. An entry is made in the journal. The relevant date, description, folio and debit amount is added. In this example, the description shows the account which is impacted, the folio which shows as GL or General Ledger, and the amount of £255. We then enter the second entry, which goes to the customer's account under the sales ledger or noted as SL in the folio, and we also enter the amount that corresponds to the first entry of £255. A reason for this entry has then been added below. In this example, it is stating that it has been identified as a bad debt or irrecoverable, so has been written off. Step 2 is that the customer's account is credited. So the relevant information, such as the date, description and credit amount, is then added to the account. And the third and final step is that the bad debt or irrecoverable debts account is debited. And the relevant date, description and debit amounts can be added like this. Thank you for watching. We look forward to seeing you in another video.